Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and privilege to welcome back Willie Goldberg. Hi, Willie.
Hey, Mike. How are you?
I'm great. How are you?
Doing well. Can't complain.
Great to see you at CG last week, and thanks for coming on the podcast again.
No problem. Thanks for having me back.
So let's jump quickly into just again for the audience. Willie and Paul are partners who run discountlots.com, and we've been investing with them. We love working with them. But this episode is going to be about Discount Lots strategy in relation to what's happening out there with rising interest rates, possible recession on the horizon, how they're stress testing their portfolio, and hopefully all other good stuff. So just before we go there, a couple of quick words. What's new in the world of Discount Lots?
A lot of good things from the discountlots.com side. So we have been actually, June is going to be another record month for us. We had our past 2 weeks were our two best weeks. We've never had back-to-back weeks where we sold 40 lots a week. So things are good. New sales are rolling through, payments coming in. So Discount Lots is going well. On the flip side, we're just continuing to do more of the same. So we've got two sides of our business. For those that are listening, part is selling lots on discountlots.com on payment terms, and then we also flip properties for cash, hire realtors. We're really good at sourcing discounted properties. So we basically have essentially two disposition strategies. One is on our website, discountlots.com. The other is just listing with realtors, selling for cash. We've got some great deals in the pipeline there too. So things are good, can't complain.
That's really cool. So it's great to hear that despite the rising interest rates, people are still buying land lots in the middle of the boonies. That's your strategy. And I guess the cash flips, you do some infill lots as well, right? You do some city lots.
Right. And so just on the rising interest rate front, so we do have some lots that are in the outskirts of towns. We tend to buy in developing areas where they're sort of in the path of progress. And we buy lots in a lot of properties in subdivisions as well that have utilities basically hooked up to the property or nearby the property. Some utilities, some water, some sewer, some lots with water and sewer. So we buy the whole gambit. But just touching on the rising interest rates, we had that great presentation about affordability with Bruce Norris last week, and that was super informative and pretty enlightening to us. And we could talk about the cash side of the business, but for the discountlots.com side of the business, interest rates don't really have too much of an impact for those sales. And that's because we're basically selling the lots on terms. So we determine what the payment terms are going to be. So if interest rates go up, we're not raising rates on our customers because we sell property on installment contracts, 0% interest. So our payment terms stay the same. So those that are getting priced out in some more expensive markets in major metro areas, like Los Angeles or San Diego or Austin, Texas, or Dallas, Texas, or wherever, we don't. Our payment terms stay the same. So people aren't getting priced out basically as interest rates go up. So that aspect of our business is unaffected. So just wanted to kind of clarify that a little bit.
That's a pretty powerful comment, which makes total sense. Bruce Norris' presentation was the affordability index went from 25% to 17% in California, in Southern California. He's Mr. Southern California economist in 3 months because of the rising interest rates. So affordability of these expensive houses is under substantial pressure with the higher interest rates. But the land lots that you sell, well, what's your typical sales price now? It's still fairly inexpensive lots, like $25,000, $30,000 a lot. Is that what you sell in terms typically?
Yeah, so it's around $24,000 over, call it 7-8 years is kind of average payment terms for us.
Yeah, and you're still selling these typically on what, a 6-year term? Is that still what you're doing?
It's around 7 is our average in our portfolio right now.
So you've been essentially extending the payment term a little bit from the 6 year to 7 now to what, to lower the monthly payment?
Well, yeah, what we noticed is we had some, this was about, I can't even remember, maybe 6 months to a year ago, we noticed that some of the properties on our website were just sitting there longer than others. And we kind of dug in and started listening to phone calls, viewing property listings on our website. What we determined is that we had some mispricing, and we priced our lots, the terms based on what we bought them for, and rather than what the consumer actually is able to afford and what makes sense for them. So after that experience, we kind of went back and said, hey, here's kind of what the market's asking for. And so we basically lowered some of the terms on some of the properties and raised them on others to make them more consistent throughout, so that we had more consistent pricing terms throughout all the properties on our website. Once we did that, we noticed that our sales went up, spiked 30% the following month. So that's kind of that was a pretty reasonable pricing shift that we had, and that was called 6 months to a year ago, and that has really accelerated our sales after we made that one minor tweak.
Yeah, your whole business is data driven, heavily data driven. You're watching data, a lot of data points all the time, and this is something that let's talk a little bit about data and what we are kind of doing. So we are monitoring what you guys doing because we invest with you. And these monthly calls we do, you guys provide a ton of data, and including the collections data. So why I'm shifting there is whether the economy turns into a recession. And generally during recession, people lose jobs, and typically they lose the ability to pay for these lots. And having a lot somewhere in the, again, forgive me, I'm calling it boonies, but not somewhere near where they live, becomes a discretionary item that they may stop making payments on. So let's just talk a little bit about that, because I think it's very important to understand what data points you're measuring and how you can adjust based on that if you're starting to see more delinquencies in payments. So what kind of delinquencies you're seeing now? Delinquencies and defaults, what kind of rates? And then what would happen if you started seeing more delinquencies? Because some people are worried about this business model and they call it lots is land, the price can fall. And it's very different for builder lots, right? When the market turns, all these builder lots become a problem because people pay top dollar for them to build them. Then when the product is no longer needed, the price of builder lots fall. But these lots are not your typical builder lots. They're more of small lots where people use for recreational purposes.
Yeah, definitely. So on the builder lots, we could talk about that in a second. We are making changes as we see changes in the macroeconomic environment. But for our portfolio numbers, so I guess just fundamentally, we buy these lots, we sell them at, call it 5 to 6 times our cost. So a lot, just inherently, a lot of the and we get our money back on the cost of that lot in about 16 months. So most of the longer tail credit risk that we take on is mitigated because our margins are so high. So that's first and foremost, and why I love this business, and kind of why we try to grow and scale this business, because the unit economics of this business are just so powerful, so strong. So in terms of default rate, charge off, so we project less than 1%. And
how many percent? One more time. Sorry, I missed it. How many percent?
So we are projecting less than 1% charge off next month. And that's sort of in line where we've been. And so our delinquency is around, it hovers between 10 to 14%. It's been fairly consistent. We haven't really seen.
Explain that. 14% delinquencies and 1% charge off. I don't quite understand why that's the case.
So delinquency just means that someone is at least 1 day late on their payments, or they just missed their payment, then their credit card got declined or whatever. They're now late in our portfolio. They're in the category of 0 to 30 days delinquent. So we have around 10 to 14% in that range are delinquent on their payments. So a charge off for us is that we write that credit off as a default in our portfolio. And so that only less than 1% of our portfolio is getting charged off. We're projecting for July. Does that make sense?
So the people who are late, they eventually pay. That's what you're saying. The difference
Correct.
between 14 and 1% is your payment people call them and you say, hey, listen, you're going to lose this lot unless you're going to make a payment. Your credit card got declined for whatever reason. Go fix the problem and make the payment, right? And that's what gets that delta between 10 to 14% delinquency to 1% default.
Correct.
However long it takes you.
Exactly.
That makes sense. So we've gone through this exercise. Just kind of tell the audience what stress tests have we kind of looked at, and what are we basically preparing? Well, what are you preparing for in the case of a severe recession? What kind of delinquencies and kind of charge-offs are the stress test condition? What are we going to see? What percentage of the people will default or become delinquent? I'm just, again, for the discussion of the audience, to understand how to stress test the investments. And for us, we've been monitoring and we've had this discussion quite a bit, and we'll go back and forth. We'll continue to prepare in case of a recession. So let's talk a little bit about the stress conditions.
Yeah, no problem. So I built out basically an operating model. We've been sort of updating the model since basically we started this business. And so my background is investment banking finance. So I had the experience of building out all the details and the mechanics behind just how this will flow. So basically the levers that we wanted to pull on to stress test the model are largely the charge-off rate. And so just for context, if we were ever in a stress scenario, which we're about to be in a recession, maybe the labor market tightens and unemployment goes up and it starts impacting our portfolio, great. So what would happen in our business is we would generally tighten on our expenses. And so our business model is very flexible because we have all of this recurring revenue, and about 80+% of our operating expenses. We're a very operational heavy business, but all the expenses, the marketing, the sales are focused on growth, growing the portfolio, growing new sales. If we ever get to a point where we need to kind of take it back, we can really reduce our expenses very dramatically. And so say just in the most extreme scenario, we were to, fire all of our employees, stop spending on ads, stop spending on marketing. Hopefully this will never happen. Just kind of going through this scenario, we can basically eliminate 95% of our expenses and still have all this recurring revenue coming in. So right now we have over 1,600 payers on our portfolio, and they're making monthly payments. If we cleaned house, for example, and just started becoming a collections company where we're collecting on our portfolio, we would be able to just kind of service our debt and not really grow the business, but service our portfolio and collect revenue and be extremely profitable extremely quickly. So that's a lever that we have to pull on at any point in time if we ever needed to. And so just in the model that we put together, so you wanted to stress test the scenario. You're like, what happens if half of your portfolio falls off over this time frame? Obviously, we'll still continue to sell properties. This is an extreme scenario, one that we don't anticipate happening, but we want to be prepared for. So the levers that we tweaked in the model were the charge-off rate, and we just bumped that up dramatically. So like I mentioned, we're only projecting less than 1% charge-off for the month of July. But Mike wanted me to put okay, what happens if you put 8% charge-off? So we bumped it to 8%, and we kind of saw what the model looked like if we reduced our expenses. Like in this scenario, we kind of are more defensive and not focused on growth. So we limit our expenses and we kind of service our portfolio and assume that 8% of our portfolio is falling off over each month over the next, I think it was around 18 months, to kind of see what would happen. So that's the sort of stress test that we performed. And to the good news from that stress scenario is that, again, because we have so much recurring revenue coming in and we can be extremely lean extremely quickly, we're able to service our debt and still continue to be profitable in that scenario.
Yeah, I appreciate, Willie, the explanation. And what's really important is not the extremes. You're not going to go lay off all the people overnight. That's not the first of all, scenario highly unlikely, number one. Number two, this time that gives you opportunity to adjust. So every month you're looking at the data, and if you see the charge-off scenario growing, you can start adjusting rather quickly. In some ways, it's actually a positive thing. When the charge-off means somebody defaulting on that loan, you could put it back in the inventory and you can remarket. So it becomes easier on a buying site. You don't need to go buy those lots anymore. So you can lighten up your staffing on the new acquisitions, but you could continue to have folks on the disposition on the sales side to keep turning this inventory into new receivables. So without spending a ton more time, what would you do if you start seeing the delinquency rate increasing? So in other words, right now you're dealing with 1% for July. What if you start seeing the 1% becomes 1.5% and then 2%? Kind of what's a normal course of action when you see the market conditions beginning to change? And the beautiful part about this is that this stuff doesn't change overnight. It takes typically a couple of years for the problems to kick in. So if anything, you're going to see a ton of data that's going to point you in the direction where you got to adjust the business.
Right. So, I mean, if we see sort of increases in bad numbers, like you mentioned, obviously we will want to retract a little bit. So on the, just generally speaking, our company, we are lightening our load on just overhead. So we're making that tighter anyway. We're getting much more efficient with our expenses, and on our servicing aspect, we're getting a lot leaner from on that aspect. So our overhead for our customer service and collections team in the next, call it 3 to 6 months, is actually going to be meaningfully lower than it is today. So we feel very good about where we are from that aspect. So, and if we do start to see bad numbers on the portfolio, what that would really do is, and tell me, is that the long-term value of a new customer is now going down. So it obviously depends on how bad the numbers are, but if the LTV of a customer is now going down, we're going to want to spend less on marketing and sales and make sure that our cost per new customer is now going down. So say it costs on average $2,000 per sale for marketing and sales spend, just numbers. We're now going to want to make that probably, even though like we feel very comfortable in saying that the LTV of a customer is 10, 15, 20,000, it could be in that range. But we feel right now that we're actually very conservative on those customer acquisition costs. We would get even more conservative, and we would start to spend less on marketing, less on sales, and just make sure that we're really hedging in case these new customers that we're adding to our portfolio are not there for the long term, because now the economy's hard and maybe people are losing jobs, and we now think that they're not going to make it as far in their payment terms as they would have maybe in a better economic environment. So we'll get a lot more lean on marketing, a lot more lean on sales, and just generally speaking, we're getting a lot leaner on just overhead customer service and that aspect of our business. So that's stuff that we're doing anyways. And just on new inventory acquisitions, we would cut that off most likely pretty dramatically in the event that the portfolio starts turning off. We obviously don't want to spend a ton of money on new property acquisitions. So we would just be a lot leaner in that scenario.
That makes sense. So what percentage of your total lots that you have in the portfolio are the unsold inventory? In other words, I think you said you have 1,600 customers, or I don't know how many lots, but how many basically lots are in the inventory approximately relative to the total portfolio that you have sold as receivables?
So we have on our website, if you go to our website, we probably have between around 500 to 600 lots available for sale. So we're actively selling. I mean, this month we will probably sell around 150 lots. So if you do that math, we have, call it 4 months of portfolio, some cancel, so maybe 5 or 6 months of inventory. We're actively getting that down. We have, so that's kind of where we stand right now, and we're looking to get leaner. We have a good amount of land in our core markets to sustain us for a little while. So that's kind of where we are. And we're trying to get a little skinnier on the inventory front, and we will continue to do that. Whether there's a recession or not, we're going to continue to get leaner.
Well, the question is just in time, right? So if you have just in time lots, then you have the limited inventory. And then if you sell those and you got a problem, you got no new product, right? So you have to maintain a certain amount of inventory at all times. And given how cheap you buy them, maybe 5-6 months of inventory sales is not bad at all, because there's such an inexpensive inventory. And is this an accurate number? So 500 lots inventory and about 1,600 lots sold, right? Roughly.
Yeah, we have about I would say 600 lots on the website. And I mean, yeah, in markets like Florida, it's really hard for us to keep property on the site. Those are growing so fast at this point that we'll most likely continue to just buy over there and just replace, because we're really seeing a big demand there that we haven't really before. So that's something new, and we're going to continually replace inventory. As we see opportunities, we'll want to continue to replace and make sure that we're adequately stored on our website.
Yeah, it makes total sense. I appreciate sharing all this data. And so share with the audience, how would folks learn more about you? Is just, I guess, the website, discountlots.com, right?
Yeah, you can go to discountlots.com. You can email me, Willie, WILLIE at discountlots.com. If you're curious, you want more information, happy to share.
So thank you kindly, Willie. Thank you for sharing. And it's not easy to talk about stress testing your business. You always want to think, hey, it's going to grow, it's going to do well. It's kind of like a painful exercise to go through stress test conditions. It's almost like they really have to do that. But the good news is that preparation makes you feel pretty good about preparing for a downturn. And hopefully you're not going to see any serious downturn in the business you're in. There may be correction in the expensive, overpriced housing properties versus the land lots, which are relatively inexpensive. And maybe your $1.5 million home can drop in price to, just say 20%. If the market is overheated, it can drop to 1.3, 1.25, and then range. While the $25,000 lot, is it likely to, even if it drops, saying 20, 30%, you're still in pretty decent shape because you bought it for $5,000. So from that perspective, it's not a big deal from that perspective, from that point of view. And as long as folks are paying for what they bought and these receivables are sticky, your business is really, I love this comment about your business. It's like a used car business, except for the land doesn't depreciate. You don't have to worry about the car being, getting older and being beaten up, and you don't have to repossess. You don't have to go find the car. And if they don't pay you, just basically, they default on their contract. You put that property right back in the inventory. Right.
Our head of collections comes from JD Byrider. She has about 15 years experience doing auto loan collections, and the stories that she tells us and about having to repossess cars and how they have to basically write off about $5,000 to $10,000 each car every time they repossess it. It's just not, it doesn't impact our business because the charge off is so less. We basically get the land back and relist it on the website and offer the same terms, if not better, than we originally offered. So from that standpoint, we're significantly protected. And I do want to just say that things are going super well for us right now on the sales front. So new sales are crushing it right now. And we're pretty optimistic about where we're going from here.
Willie, thank you kindly. We appreciate the opportunity to invest with you. We've invested with you from Tempo Income Fund and Tempo Opportunity Fund, and really enjoy working with you and Paul. And you guys are super responsive and super data driven, which makes a big difference when you have a business driven by data, not touch and feely. And you guys are incredibly well organized. So I'm grateful for the opportunity to be working with you guys too.
We appreciate it, Mike. We like working with you guys too.
Thank you so much, Willie.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnik. Keep listening and keep investing Big Mike style. See you on the next episode.